Hello, and welcome back to Financial Education. My name is always Zach Collins, and today I'll be going into a few different budgeting strategies that people use to make sure they keep on top of their income and expenses. We're living through a period of high inflation, and wages are not keeping up. This means it's very important to keep on top of your budget and make sure there's no shortfalls that end up being covered by high interest debt, spiraling you more and more into debt over time. Before we get into that, for those who don't know me, what is my background? I was a financial advisor in my past, fully licensed, fully FISA compliant, specializing in super and non-super investments. I'm not licensed anymore, but I would love to get my license back one day. I chose to leave the industry as I couldn't stand the owner of the business, and his firm was very heavy in sales. I have no interest in sales. It's not all sales, but my passion is to help people not to sell various managed funds or insurance products. These days, I work in tax and compliance. Now, there are four very common budget strategies that people use that I'll be going through today, and they are the zero budget, pay yourself first, the 20, 30, 50 budget, and the envelope budget. The zero budget and pay yourself first budget are both very similar, but you approach the issue from opposite ends. With a zero budget, you basically zero out the different allocations every pay cycle. For example, let's say you've got $100 that you want to put to food, and then spend $90. Now you've got $10 left over. If you allocate 50 to your phone bill or internet, and you say you spend $49, there's $1 left. What happens with your savings? That is where the surplus goes. It's not a predetermined number, and so the amount you save each pay cycle would change based on how much you actually spend and what is left over. That's where the zero budget gets its name from. You're zeroing out your different budget buckets to zero at the end of each pay cycle, and you've spent your way down to basically no surplus. Unless you're really good at following your budget for each of these spending categories, the possibility of exceeding your budget in any particular one is quite high. You might say underspend like $5 on one category, but then you might overspend $50 in another, meaning net you're overspent by $45, which is it's not a great place to be. The type of person that would be drawn to something like this is someone that wants to be more disciplined with their savings and spendings, but they also don't want to be say too formal and limit their expenditure when something unexpected like does come up, like a concert or travel. The pay yourself first approach, as I mentioned, is very similar to the zero budget, except you allocate a set amount to your savings first. You decide how much you want to save each pay cycle. That can be as low as like a couple of dollars, or it can be as high as the majority of your income. The difference is the second that you receive your pay, that predetermined amount, whatever it is, you immediately move it into your hard savings and you don't touch it again until it's time for it to be used for its intended purpose. With the amount you're left, then you stick to your regular budget. If there's any money left over, you can splurge or spend it however you want because you already have that dedicated savings buffer. If that's not enough and it's still a few days from your next pay, that's when you can take a hard look and be like, do I want to cut down on my spending or do I want to cut into my savings? It's better not to cut into savings, but because you've already got that dedicated amount, you've got that option. Next up, we have the envelope budget. With the envelope budget strategy, there are two ways you can do it. Now, number one is with a number of different bank accounts, each with their own transaction account or debit card. Or number two, you can use the namesake and have a bunch of envelopes and use cash. I saw this budget go viral on TikTok a couple of years ago now, and people are talking about how brilliant it is. You know, the thing is, it's been around a really long time. It's really not anything new. Possibly the concept of using cash for everyday expenses instead of mindlessly tapping a card could have been what made people's minds get blown. I know I don't use cash, and it's a lot harder to track. When everything is just a number on my phone. Anyway, the envelope strategy is fairly straightforward. At the start of a pay cycle, you take out however much you need. You put that into an envelope titled for whatever type of expense that you're budgeting for. If you only want to spend, say, $50 going out to eat, you just chuck in a 50. If you want to spend $300 on groceries, in goes $300 into that groceries envelope. Similar to the pay yourself first budget, once your envelope is out of cash, it's out. There will be no more money allocated to that expense until the next payday. Before I move on to the final budget strategy, I do want to say once you've run through your budget, it's not always the end of the world. Hopefully, you've set aside some savings from your pay and you can dig into that if an emergency does come up. What most people do to save money when they're out is they skip meals. Please don't do that. This isn't a health channel, but skipping meals to save money is not good for you and will probably be a detriment to your working career and future income earning potential. So please don't, just stop eating for a week if you run out of the allocated funds. If you do run out of money, this is then a really good time to look at what you're actually buying. Are you buying takeaway for lunch and dinner every day? Are you buying too many video games? Are you gambling, drinking, smoking, whatever it is? Ask yourself, does this expense need to be incurred? Does it make you happy? If you need to reduce your consumption or cut it completely in order to stay within your budget, that's where you need to make the sacrifice and decide, is this expense worth it to me? If yes, time to increase the budget. And you can either cut down on your savings, which will negatively impact future you, or you can see if you can reallocate from some other spending category. I've personally, cut out almost completely buying meals at work and coffee. It's not the end of the world if I do buy lunch or coffee, but I've been saving a couple $100 every month by doing that. And it's really noticeable, how even something small like a $5 coffee every day, it does add up. It's not going to make me a millionaire, but maybe it's an extra amount that I can use to upgrade my phone more regularly instead of waiting until it gets bricked to get a new one. Or maybe I can now afford a small holiday for my family at the coast. Whatever it could be. The final budget is called the 50-30-20 budget. And this is one that is very common and it's talked about a lot online and with financial YouTubers and influencers. Why is it called 50-30-20? It's because 50% of your income goes towards your needs. This is stuff like rent or mortgage or groceries, petrol for your car, utilities, etc. 30% goes towards your wants. In this 30%, I would actually include some stuff that's maybe already in the 50% category, but maybe you want to make it a bit more luxury. You could buy a cheap car. That would come out of your need. If you have to travel for work, if you can't get public transport or whatever. But getting a more expensive one, 100% that is a want. It's a difference between these two cars that would say, you should be allocated to the 30%. Other expenses that come out of your 30% want budget would be stuff like, say, going out for dinner or a gym membership and holidays. The final 20% is for your hard savings. So saving could be a short-term or long-term goal. This can be done with, paying out cash in the bank, nothing wrong with that. It could be investments in managed funds or ETFs. It could be in longer-term investments like super. Make sure to check out my other videos on the channel on these topics, where I give a brief overview of how all they work. In Australia, we are very lucky that we get super guarantee paid on top of our gross salaries. This 12% is already a forced savings. I personally try and save on top of my super guarantee, but I know a lot of people in a lot of debt, and there's a good reason they're in debt. They would argue that it's better to cut your savings allocation, increase the other two spending categories. At least they can't spend their super guarantee because they probably would. When it comes to budgets, there is no one size fits all. Everyone has a different spending habit, and the psychological nature of one over the other can vary for different people, and it could be the difference between keeping to a budget or not. So hopefully I have been able to give you a bit of a better understanding of the premises behind how to budget and the different types of budgets, allowing you to pick the one that works best for you. If you've got any more questions, please feel free to drop a comment below and answer if I can. Thank you guys so much for watching, and I'll see you on the next one.